Good day, everyone. Thank you for joining us once again here at VBC for our quarterly briefing on the Community Bank Benchmark Group. So we're going to look at this benchmark group and the performance for the third quarter. And if you recall, this benchmark group includes institutions with assets between 100 million and 5 billion. So this just makes up our Community Bank Benchmark Group. So when we look at this group, we like to look at, okay, how has the balance sheet fared throughout the quarter? And we can see within this chart that the overall asset growth improved quarter over quarter. It was 0.96% last quarter. Assets grew by 1.1% in the third quarter of 2023. So we did have some additional growth, and we can see overall loan growth went up about 2.17%, a little below where we saw in the second quarter at 2.86%, but we continue to see growth, and that is important. As for the fourth quarter, with our involvement in different ALCO committees and talking with a variety of banks, we have heard some institutions start to say that their overall loan pipelines have been thinning out, and that expectation is that we're going to start to see more of a slowdown in the loan growth throughout the remainder of this year and then most likely into next year. However, as for deposit growth, deposits continued to expand in the third quarter. We were up actually 1.3%. That is a great level of growth compared to what we saw in the second quarter, where we actually saw a contraction of deposits of 23 basis points, or down 0.23%. So the overall growth in deposits has been relatively strong, and hopefully we've seen the end of the exits of some of our deposits. And this wasn't just solely because of brokered CDs being put on the balance sheet, because we can see net of broker deposits, both CDs and non-transactional accounts. We can see that overall level of growth was 1.01%. So that is a positive in here. We are seeing the deposits growing in the third quarter, and we hope to see that again into the fourth quarter. Of course, that comes with the cost of overall higher level of deposit cost in terms of the deposit rates. But that's something we just have to deal with at this time. When we look at the industry in terms of collectively for all commercial banks put out by the FDIC here, you can see the overall level has leveled out. So we haven't seen that runoff that we were seeing at the end of last year, beginning of this year. In terms of the overall level deposits, we've leveled off, and that surge measured as the difference between the actual level deposits and the trend growth line has reduced to under $1 trillion. We're at just 0.9 trillion in that surge level, and we can see it's getting pretty close together. So it'll be maybe another couple of quarters before we get back on track and we get the overall level of deposits back in line with our level of trend growth in here. So we're going to continue to monitor that to see when those two lines converge. But in terms of the overall level returns on the benchmark group, the ROA dips below 1% for the third quarter at just 0.97, so just 3 basis points below that 1% threshold, I like to say. We always strive to be above 1% in the community bank realm, and the median here has dropped below that at 97 basis points, off about 20 basis points year over year. And a lot of this reduction came in the form of the overall level of net interest margin coming down, which we'll talk about in just a minute. But we like to break down this ROA for the subgroups, looking at those banks that file under a subchapter S election, the stock institutions, and then the mutual institutions. So overall, we have seen a decline in each of those subgroups. And in fact, we saw the mutual institution group get down to just 36 basis points as a median for that group. The stock group came down 3 basis points to 0.92. And then the overall level of subchapter rest, which remember these institutions do not pay taxes, came down about 2 basis points from where they were in the second quarter to 1.27. So it's always important to compare our returns after taxes to similar groups, or you can simply look at the pre-tax level of return on average assets. But as I mentioned before, the driving force behind that is the continued pressure on net interest margin. In fact, moving down another 4 basis points down to 3.35% for the median of the benchmark group, coming off of its high back in the fourth quarter of 2022 at 3.6%. So we've seen this pretty significant reduction because of the catch-up we had to have as an industry in the overall level of deposit rates. And we saw that, throughout the beginning part of this year, the trajectory of the increase in cost of funds was fairly steep. In fact, we're up to, for our cost of funds, at 1.65%. That's a substantial number considering we were last year at this time at 37 basis points. So we're almost 4.5 times the level of cost of funds we saw last year. And this was a driving force behind that contraction in net interest margin. That increase in cost of funds far outweighed the improvement we saw in the yield on earning assets, pushing down that overall net interest margin. Now, for the fourth quarter and into the first quarter of 2024, our expectation is this trajectory here is going to kind of flatten out a little bit. We shouldn't see as quick of growth in the overall level of cost of funds, so that should help our net interest margins hopefully level out and maybe pick up a little bit, particularly with what has happened on the long end of the yield curve with the 10-year moving up throughout the quarter. But when we look at the level of deposit costs and we look at the cost of interest-bearing deposits, we can see from 47 basis points back in the third quarter of 22 up to 200 basis points in the most recent quarter. So that's a substantial level of increase here. In fact, when we look back to the beginning of 2022, in the beginning of the overall increase in the Fed funds rate, when the Fed started their tightening, we're up on that overall interest-bearing deposits up 169 basis points compared to the 525 basis points to the overall change in Fed funds. So the beta that we look at in ALCO and in our ALM models, that beta for overall cost of interest-bearing deposits was up 32.19%. So that's the overall beta. Now that includes the time deposit. So when we strip out time deposit, we look at the sector betas in terms of interest-bearing transaction accounts and savings and MMD accounts, we can see much lower betas, 11% on interest-bearing transaction accounts, and savings and money market accounts at about 20.2%. Much lower type of betas. So that's what we've experienced collectively throughout this entire tightening cycle up to this point. Those are the betas. So check those with your ALCO committee and what's in your ALCO model and see if they're aligning. And as always, it's important to make sure that we have good assumptions in those ALCO models in terms of where our betas and where our average lives for our non-maturity deposits. And it's we've gone through this rate cycle and we have a good footing in terms of being able to back test some of those assumptions. But when we look at the interest-bearing deposit costs from state to state across the United States, we can see the highest state with the cost of funds of cost of interest-bearing deposits of 3.39% is Rhode Island. The lowest is at 47 basis points, and that's all the way out in that Pacific Ocean, with Hawaii being at just 47 basis points. So that's, you can take your overall level of cost of interest-bearing deposits for the third quarter and kind of benchmark it against where your state overall average is. But a big portion of the movement in these cost of funds and the cost of interest-bearing deposits, while the interest rates have had an impact, we also see that the mix in deposits has changed in this migration from non-maturity deposits into time deposits has been significant. In fact, at the end of the third quarter of 22, we saw that just 17%, almost 17.4% of the deposits were held in time deposits for the industry, and that a year later jumped to 25.3%. So we've seen this migration occur in our deposit structure, and this is something that we were expecting, because we're getting more in line with where we were pre-COVID. So it's just a natural tendency to things to come back to their mean reversion. So we've seen that happen throughout 2023 so far, and most likely we'll see this continuation occur throughout the fourth quarter and maybe a little bit into the first quarter. But we should be able to see some sort of reduction in that then, in terms of the reduction in the migration. Taking a step back and looking at that non-interest portion of the income statement, looking at net overhead, if you recall, is the difference between non-interest expense and non-interest income. So it's a way for us to look at efficiency without bringing in the net interest margin. So overall net overhead kind of leveling out at 1.91%, up from where we were back in the third quarter of 22 at 1.86%. So we've had this kind of significant volatility in net interest margin since COVID, because of the amount of money that came into the system, ballooning our balance sheets. And now we're starting to see that kind of level out, and the expenses begin to catch up as a proportion to overall assets. So this overall net overhead is beginning to become stabilized once again. And we can see the components of net overhead in terms of non-interest expense and non-interest income. Non-interest income been fairly stable at around that 44 basis points, and non-interest expense being somewhere around that 2.4 to 2.5% throughout 2023. So that's where we're kind of headed. We should see an uptick in the fourth quarter, which tends to happen, but then it usually comes back down in the first quarter. So we'll expect that to happen in terms of non-interest expense, but we're still continuing to do a very good job in terms of monitoring and managing our expense structure. In terms of risk, using that S&P total risk score, we know overall the risk has moved up from where we were in past years, and we continue to see incremental movements higher and higher, getting closer to the moderate to high level of risk for the industry. When we look at the different components, capital risk continues to be at that higher level. Some of that has to do with the overall level of the equity asset ratios being impacted by the unrealized losses on the investment portfolio. So that has a little bit of an impact there. Overall credit, though, credit continues to be strong in terms of what we see on the bank's balance sheets for the Community Bank Benchmark Group. We haven't seen a rapid uptick in any of the non-performing loan sectors. And we know there's some high frequency data out there that might suggest that's coming. But as of the third quarter, we really haven't seen that hit the overall level of banks, of community bank balance sheets. And hopefully we will not see that occur. Liquidity risk, though, we continue to see this uptick with the need to fund the balance sheet with wholesale funding increasing. We start to see this liquidity ratio or this liquidity risk number start to pick up in here. And that's continuing to go up. And also built in there is the liquidity of the investment portfolio. And once you get to a discount of about 15%, the liquidity of that portfolio begins to pull off, and we mark that as an increased level of risk for institutions. And because of their rise in their long-term rates throughout the third quarter and into the fourth quarter, we continue to see an increase in that devaluation of those portfolios, impacting that liquidity. And then in terms of earnings at risk, if you recall, we look at earnings at risk as a level of sensitivity or volatility of the net interest margin over the past 9 quarters. So this is backward looking. And because of that volatility, we've seen the overall earnings at risk level get up here to that moderate to high zone on average for the institutions in our benchmark group. We expect this as we begin to see the leveling off of cost of funds, and hopefully the lifting up more so in the yield and earning assets, that overall net interest margin pressure will abide, and we'll start to see some flattening out or more consistency in those net interest margin, which would then bring back down the overall level of earnings at risk. So that's what we have for you this quarter. We hope you enjoyed this briefing, and we look forward to bringing you the fourth quarter briefing in February of 2024. Have a great day, everyone.